What if I told you that the most powerful financial institutions on the planet, the ones who literally print money, are quietly, desperately buying gold? Not talking about your average investor, not hedge funds, not crypto billionaires. I'm talking about governments, central banks, the very institutions that built the modern financial system on paper currency are now hoarding the one asset that existed long before any of them did, and they're doing it at a pace the world hasn't seen in decades. Gold is sitting at $4,700 an ounce right now. Let that number sink in for a moment. Just 3 years ago, analysts were debating whether gold could hold $1,800. Now we're at nearly 3 times that level, and the people buying aren't panicking retail investors or doomsday preppers. They're central bank governors. In suits, sitting in marble buildings in Beijing, Kuala Lumpur, Seoul, and Moscow, signing off on billion-dollar purchase orders and saying nothing publicly about why. So what do they know that you don't? That's the question we're going to answer today on the John Mindset, and I promise you by the end of this video, you will never look at gold, the dollar, or the global financial system the same way again. Because what's happening right now isn't just a commodity price story. It's not just about inflation or interest rates. What's happening right now is the slow, deliberate, carefully coordinated dismantling of the world financial order that has governed every economy on the planet since 1971. And gold, this ancient, heavy yellow metal, is the weapon of choice. Stay with me, because this is going to get deep. And if you're new to the John Mindset, this is exactly what we do here. We take the stories that the financial media gives you in 30-second headlines and we pull the thread until we find out what's really going on. So hit that subscribe button, because this is one you'll want to share. Let's start from the very beginning. To understand why what's happening today is so significant, you have to understand a little bit of history. And I know history sounds boring, but bear with me, because this particular piece of history is essentially the origin story of every financial problem the modern world has right now. For most of recorded human civilization, gold was money, not a representation of money, not a store of value. It literally was the money. Kings paid armies with it, empires were built on it, trade routes stretched thousands of miles across deserts and oceans because of it. Gold had 3 properties that made it the perfect form of money. It was scarce, it was durable, and you couldn't just create more of it out of thin air. That last point is critical, and we're going to come back to it. Fast forward to the 20th century. After World War II, the world needed a new financial framework. The old powers of Europe were shattered. America was the last man standing, economically dominant, militarily supreme, and sitting on more than half of all the gold reserves in the world. So in 1944, representatives from 44 nations gathered in Bretton Woods, New Hampshire, and they built a new financial system around American strength. The deal was simple. Every major currency in the world would be pegged to the US dollar, and the US dollar would be backed by gold at a fixed rate of $35 per ounce. This gave the world stability. It gave international trade a common reference point, and it gave the United States an extraordinary privilege, the ability to essentially act as the world's banker. But here's where it gets interesting. By the late 1960s, the United States was spending enormous amounts of money on the Vietnam War, on social programs, on maintaining its global military presence. And it was printing dollars to pay for all of it. Other countries started to notice. France, under President Charles de Gaulle, famously sent a warship to New York Harbor loaded with dollars to exchange for physical gold. De Gaulle didn't trust paper, he wanted the real thing. The pressure became unbearable, and in August of 1971, President Richard Nixon made one of the most consequential decisions in modern economic history. He closed the gold window. He told the world, the dollar is no longer redeemable for gold. Just like that, the link between the world's reserve currency and physical gold was severed. What we've been living with ever since is what economists call a fiat currency system, currencies backed not by any physical asset, but purely by government decree and the trust of the people who use them. Now here's what that decision really meant in practice. It meant that for the first time in history, every government on earth could print as much money as it wanted, constrained only by its own discipline and the faith of its creditors. And as you might imagine, governments didn't always exercise restraint. The result over the past 50 years has been an unprecedented expansion of global debt. Total global debt today is somewhere in the neighborhood of $300 trillion. The United States alone carries over $36 trillion in federal debt. The dollar has lost more than 97% of its purchasing power since the Federal Reserve was created in 1913. And now, in 2026, a growing number of central banks around the world appear to be reaching a quiet but unmistakable conclusion. The system built in May 1971 be approaching its limits. And if that system cracks, if confidence in the dollar as the world's reserve currency begins to erode, then the one asset that has served as real money for 5,000 years becomes extraordinarily valuable. That's why gold is at $4,700, and that's why central banks are buying it like there's no tomorrow. Let's talk specifics, because this is where the story really gets compelling. We're not dealing in theories here. We're dealing in documented, verifiable behavior by sovereign nations, and the data tells a very clear story. The World Gold Council, which tracks central bank gold purchases globally, has been reporting elevated buying levels for several years running now. But what's changed recently isn't just the volume, it's the geography. The countries doing the buying have shifted dramatically, and the countries doing the selling have shifted too. That divergence tells you everything about the geopolitical fault lines reshaping the global economy. China is the name that comes up first, and for good reason. The People's Bank of China has been systematically adding to its gold reserves for years. Officially, China reports its gold holdings to the IMF, but most analysts believe the actual figure is significantly higher than what Beijing discloses publicly. China has a strategic incentive to be opaque about this. If markets knew the full scale of Chinese gold accumulation, it would send a signal so powerful it could accelerate the very dollar decline that Beijing is quietly preparing for. So they drip-feed the numbers, buy steadily, and say very little. But China isn't alone. Malaysia has re-entered the gold buying market after years of inactivity. South Korea has resumed building its reserves. Uzbekistan has been one of the most aggressive buyers in recent months. India continues to add gold not just through its central bank but through its cultural channels. Indian households collectively hold more gold than almost any other nation on earth, and the government views that as a strategic asset. Even smaller emerging economies across Southeast Asia and Central Asia are diversifying away from dollar-denominated assets and into gold. Now compare that to what's happening on the selling side. The Bank of Russia sold gold in recent months not because it doesn't believe in gold, but because Russia is under severe sanctions and needs to liquidate assets to fund its war economy, when even a sanctioned, isolated country like Russia would rather sell gold than dollars. Because it has very few dollars left to sell. That tells you something profound about how geopolitical isolation reshapes financial behavior. And here's the number that should make every American investor sit up straight. Global central bank gold purchases in 2024 and 2025 were running at roughly 27 tons per month on average. That is an extraordinary rate of accumulation. For context, the entire global gold mining industry only produces about 300 tons per year. Central banks collectively were consuming the equivalent of nearly 10% of annual global gold production just to add to their reserves. When demand of that scale shows up in any market, housing, oil, semiconductors prices go up. Gold at $4,700 isn't a mystery. It's basic supply and demand, turbocharged by sovereign-level strategic buying. But here's the question that demands an answer. Why now? Central banks have always had the option to hold gold. Why are so many of them choosing to act at this particular moment in history? The answer to that question requires us to look at the deeper forces reshaping the global financial order, and this is where the geopolitics comes in. To understand the full picture, you need to zoom out from the gold price charts and look at the world map, because the gold buying isn't happening in a vacuum. It's happening against the backdrop of the most significant geopolitical realignment since the end of the Cold War. And when you connect those two things, the political and the financial, the story becomes almost uncomfortably clear. Let's start with the event that changed everything: the freezing of Russia's foreign exchange reserves in February 2022. When Western nations responded to Russia's invasion of Ukraine by sanctioning the Russian central bank and freezing approximately $300 billion of Russian dollar-denominated reserves held in Western financial institutions, it was presented to the public as a bold, unprecedented financial sanction, and it was unprecedented. Never before had the world's major democracies collectively frozen the reserve assets of a G20 nation. The intention was to cripple Russia's economy and force a rapid end to the conflict. But here's what happened in boardrooms and central bank offices in Beijing, Riyadh, New Delhi, Jakarta, and dozens of other capitals around the world. Finance ministers and central bank governors looked at that news and asked themselves a deeply uncomfortable question. If the United States and its allies can freeze Russia's dollar reserves that Russia accumulated legally through decades of trade, what's to stop them from doing the same to us if we ever find ourselves on the wrong side of Washington? That question doesn't require you to be an enemy of America to ask. You just have to be a rational actor managing your nation's financial security, and the rational response to that question, if you're sitting on hundreds of billions of dollars in US Treasury bonds and dollar reserves, is to diversify, to find assets that cannot be frozen, assets that cannot be seized by executive order, assets that exist outside the Western financial plumbing of SWIFT and correspondent banking and US custodians. There is exactly one asset that fits that description perfectly. It's gold. Physical gold held in your own vaults on your own soil is beyond the reach of any foreign government sanctions. It cannot be frozen, it cannot be deleted, it doesn't exist on any server in New York or Brussels, it's just metal, and suddenly the central bankers of the developing world found themselves extremely interested in owning more of it. This is what analysts call the weaponization of the dollar driving de-dollarization. It's a feedback loop. The more aggressively the United States uses financial sanctions as a foreign policy tool, the more countries outside the Western alliance seek to reduce their dollar exposure, and the more they reduce their dollar exposure, the more they need an alternative. Gold is the oldest, most universally trusted alternative. It has no counterparty risk, no government can default on gold, and in a world where trust between major powers is deteriorating rapidly, an asset with no counterparty risk becomes priceless. Now layer on top of that the current situation in the Middle East. The US-Iran conflict has escalated dramatically in early 2026. The Strait of Hormuz, the narrow waterway through which roughly a fifth of the world's oil supply flows, has been functionally disrupted. Brent crude crossed $100 per barrel. Energy inflation is spiking. The Federal Reserve is facing an almost impossible choice: raise rates to fight energy-driven inflation and risk crashing an already fragile economy, or hold rates steady and let inflation run hot. Neither option is good. Both options erode the purchasing power of dollar-denominated assets, and both make gold, the one asset that has historically preserved purchasing power across centuries of monetary chaos, more attractive. Then there's the US-China dynamic, which is arguably the single most important geopolitical variable in the global economy for the next decade. The relationship between Washington and Beijing has been deteriorating for years across every dimension: trade, technology, military posture, Taiwan, South China Sea sovereignty, semiconductor restrictions. Both sides are engaged in what can only be described as economic warfare in slow motion. The US has imposed sweeping restrictions on advanced semiconductor exports to China. China has responded by tightening its grip on rare earth elements, the critical minerals without which modern electronics, electric vehicles, and military hardware cannot be built. Both sides are weaponizing economic interdependence. And in this context, China's gold buying takes on an entirely new dimension, because here's the thing about gold that most Western financial commentators miss. Gold is not just a hedge against inflation for China. Gold is a strategic asset in the context of great power competition. Every ton of gold the People's Bank of China adds to its vaults is one more ton of reserves that cannot be sanctioned, seized, or frozen by the United States in the event of a serious confrontation over Taiwan or any other flashpoint. China is not buying gold because it's scared of inflation. China is buying gold because it is preparing its financial system for a world in which the dollar may no longer be a safe place to park national wealth. And here's where it gets truly geopolitically significant. China has been working for years to internationalize the yuan as an alternative reserve currency. The petrodollar system, the arrangement by which global oil trade is priced and settled in US dollars, is being quietly challenged. Saudi Arabia has had conversations about accepting yuan for Chinese oil purchases. Russia and China have dramatically expanded their bilateral trade in non-dollar currencies. The BRICS nations, Brazil, Russia, India, China, South Africa, and now several new members, have been actively discussing a new reserve currency framework, and gold has been mentioned as a potential anchor for any such system. Now, to be clear, none of this is imminent. The dollar's position as the world's reserve currency is not going to collapse overnight. The depth of US financial markets, the size of the dollar's network effects, and the lack of a credible immediate alternative mean that de-dollarization is a decade-long process, not a sudden event. But the direction of travel is unmistakable, and central banks don't buy gold for the next 6 months. They buy gold for the next 50 years. What they're doing right now is positioning for a world that doesn't fully exist yet, but that they can see coming. Let's bring this back to the immediate present, because the macro backdrop right now in April 2026 is genuinely one of the most complex and dangerous environments for financial markets in a generation, and it matters directly to the gold story. The Strait of Hormuz disruption has injected a supply shock into an already fragile global economy. Brent crude above $100 per barrel isn't just an energy story. Energy prices feed into everything: transportation costs, manufacturing inputs, food production, heating, cooling. When oil spikes, inflation doesn't just rise in the energy sector. It bleeds through the entire economy over the following 3 to 6 months. The full inflationary impact of this shock hasn't even shown up in the official data yet. Economists expect it to appear in April and May CPI readings, and when it does, it is going to be ugly. Now here's the bind the Federal Reserve is in. Before the Iran shock, inflation was actually moderating nicely. Core CPI was running around 2.5%. The Fed was cautiously optimistic that it could manage a soft landing, bring inflation down without crashing the economy. But now, with a major energy supply disruption driving oil prices sharply higher, the inflationary calculus has changed completely. The Fed's own updated projections already revised the PCE inflation forecast upward, and the market has repriced its expectations for rate cuts sharply lower, where before investors were pricing in 2 or 3 rate cuts in 2026. Now the consensus is maybe one if that. But here's the cruel irony for the Fed. This inflation isn't demand-driven. You fight demand-driven inflation by raising rates, you make borrowing more expensive, cool spending, reduce demand, prices come down. But supply shock inflation is different. It's not driven by too much spending. It's driven by too little supply, raising interest rates doesn't put more oil through the Strait of Hormuz. It doesn't increase Iranian production. The Fed raising rates in response to an oil supply shock just makes the economic slowdown worse without necessarily fixing the inflation. It's like trying to cure a fever by also breaking the patient's leg. This environment, high or rising inflation combined with slowing growth, is what economists call stagflation. It's the nightmare scenario for financial markets because there is no clean policy response. And historically, stagflation is the single best environment for gold. In the 1970s, the last time the world experienced serious stagflation, gold rose from $35 per ounce to over $800, a gain of more than 2,000% in a decade. The circumstances today are not identical to the 1970s, but the parallels are striking enough to make serious investors very uncomfortable and very interested in gold. Add to this the state of global equity markets. S&P 500 companies are still reporting earnings growth. The blended estimate for Q1 2026 is around 13% year over year, which is impressive, but markets sold off hard in March. The MSCI All Country World Index fell more than 7% in a single month. Emerging markets fell 13%. The question hanging over every earnings call this quarter is whether oil-driven cost pressures and deteriorating consumer confidence will start showing up in company guidance for the second half of the year. If they do, the equity sell-off that began in March could have a lot further to go, and when stocks fall hard and bonds aren't providing their traditional safe haven cushion because inflation makes bonds unattractive, where does smart money go? Gold. The IMF's new Global Financial Stability Report, released just today, flags that passive funds and ETFs, the investment vehicles that tens of millions of ordinary people around the world use to save for retirement, are highly sensitive to shifts in global risk sentiment. When global risk spikes, those funds experience outflows. That selling pressure in stocks and bonds pushes more capital toward real assets that have held their value through wars, inflations, currency collapses, and the fall of empires. Gold again. Now we get to the biggest question of all, the one that the title of this video promises to answer. Are central banks actually preparing for a new world financial order? Or is this just gold doing what it always does, spiking during moments of fear and uncertainty, only to fall back when the crisis passes? I want to give you an honest answer to this, because the honest answer is more nuanced and ultimately more interesting than a simple yes or no. Here's what we know for certain. The structure of the global financial system is under more pressure today than at any point since the original Bretton Woods era ended in 1971. The forces driving that pressure are not temporary, they are structural. Thus, China great power competition is not going away, it is going to intensify. Across technology, trade, military capability, and financial systems for the next several decades. The fracturing of the global order into competing blocks, a Western bloc centered on the US dollar and American financial infrastructure, and an emerging Eurasian bloc centered on Chinese economic power and alternative payment systems, is not a hypothesis anymore, it is a documented, measurable, accelerating reality. Within that fracturing, gold serves a very specific and irreplaceable function. It is the one store of value that both blocs accept. China trusts gold, Russia trusts gold, India trusts gold, Saudi Arabia trusts gold. The United States, whose Fort Knox holds the world's largest official gold reserves, trusts gold. In a world where the financial system is splintering along geopolitical lines, gold is one of the very few assets that bridges those lines. It is neutral, it is universal, it has no issuer that can be sanctioned, and that makes it uniquely powerful in the current environment. Now, is the dollar going to be replaced as the world's reserve currency by gold, or by a gold-backed alternative? This is where I want to be careful, because the breathless predictions you sometimes see online, the dollar is about to collapse, gold is going to $10,000 next year, the BRICS gold currency is coming in 2026, these are mostly exaggerated and often outright wrong. The dollar's reserve status is reinforced by decades of institutional infrastructure, legal frameworks, deep liquid markets, and network effects that simply cannot be replicated quickly. The world's central banks themselves hold trillions in dollar-denominated assets. They have every incentive to manage any transition away from the dollar slowly, because a sudden dollar collapse would devastate the value of their own reserves. But here's the distinction that matters. There is an enormous difference between the dollar collapsing and the dollar gradually losing some of its dominant share of global reserves. The first scenario is a catastrophe. The second scenario is already happening. The dollar's share of global central bank reserves has declined from around 71% in 1999 to somewhere in the low 50s today. That is a slow but relentless trend, and the assets replacing those dollars in central bank portfolios. Gold is at the top of the list. What we may be witnessing and what the accumulation of the evidence really does suggest is the early stages of a multi-decade transition toward a more multipolar reserve system. Not a system in which the dollar disappears, but a system in which the dollar shares reserve status with a basket of currencies, commodity-backed instruments, and gold itself, a world in which no single currency commands the unquestioned trust of every nation on earth, and in which gold plays a larger role as the neutral anchor that every party can agree upon. If that transition plays out even partially over the next 10 to 20 years, the implications for gold's price are staggering. The total value of global foreign exchange reserves is approximately $12 trillion. If central banks collectively moved even 10 additional percentage points of those reserves from currencies into gold, not an unreasonable assumption given current trends, that would represent over $1 trillion of additional gold demand in a market where the entire annual global gold supply is worth roughly $250 billion. That level of demand would be truly transformative. And here's something most people don't think about. We may already be deep into that process. The central banks don't announce their strategy in advance. They don't hold press conferences saying we are de-dollarizing and buying gold. They just quietly do it, month after month, ton after ton. By the time the mainstream financial world fully understands what has happened, the repositioning will be complete. That is precisely how major financial transitions throughout history have unfolded, not with a bang, but with a long, quiet, relentless shift that only becomes obvious in hindsight. Now we get to the biggest question of all, the one that the title of this video promises to answer. Are central banks actually preparing for a new world financial order? Or is this just gold doing what it always does, spiking during moments of fear and uncertainty, only to fall back when the crisis passes? I want to give you an honest answer to this, because the honest answer is more nuanced and ultimately more interesting than a simple yes or no. Here's what we know for certain. The structure of the global financial system is under more pressure today than at any point since the original Bretton Woods era ended in 1971. The forces driving that pressure are not temporary, they are structural. Thus, China great power competition is not going away, it is going to intensify. Across technology, trade, military capability, and financial systems for the next several decades. The fracturing of the global order into competing blocks, a Western bloc centered on the US dollar and American financial infrastructure, and an emerging Eurasian bloc centered on Chinese economic power and alternative payment systems, is not a hypothesis anymore, it is a documented, measurable, accelerating reality. Within that fracturing, gold serves a very specific and irreplaceable function. It is the one store of value that both blocs accept. China trusts gold, Russia trusts gold, India trusts gold, Saudi Arabia trusts gold. The United States, whose Fort Knox holds the world's largest official gold reserves, trusts gold. In a world where the financial system is splintering along geopolitical lines, gold is one of the very few assets that bridges those lines. It is neutral, it is universal, it has no issuer that can be sanctioned, and that makes it uniquely powerful in the current environment. Now, is the dollar going to be replaced as the world's reserve currency by gold, or by a gold-backed alternative? This is where I want to be careful, because the breathless predictions you sometimes see online, the dollar is about to collapse, gold is going to $10,000 next year, the BRICS gold currency is coming in 2026, these are mostly exaggerated and often outright wrong. The dollar's reserve status is reinforced by decades of institutional infrastructure, legal frameworks, deep liquid markets, and network effects that simply cannot be replicated quickly. The world's central banks themselves hold trillions in dollar-denominated assets. They have every incentive to manage any transition away from the dollar slowly, because a sudden dollar collapse would devastate the value of their own reserves. But here's the distinction that matters. There is an enormous difference between the dollar collapsing and the dollar gradually losing some of its dominant share of global reserves. The first scenario is a catastrophe. The second scenario is already happening. The dollar's share of global central bank reserves has declined from around 71% in 1999 to somewhere in the low 50s today. That is a slow but relentless trend, and the assets replacing those dollars in central bank portfolios. Gold is at the top of the list. What we may be witnessing and what the accumulation of the evidence really does suggest is the early stages of a multi-decade transition toward a more multipolar reserve system. Not a system in which the dollar disappears, but a system in which the dollar shares reserve status with a basket of currencies, commodity-backed instruments, and gold itself. A world in which no single currency commands the unquestioned trust of every nation on Earth, and in which gold plays a larger role as the neutral anchor that every party can agree upon. If that transition plays out even partially over the next 10 to 20 years, the implications for gold's price are staggering. The total value of global foreign exchange reserves is approximately $12 trillion. If central banks collectively moved even 10 additional percentage points of those reserves from currencies into gold, not an unreasonable assumption given current trends, that would represent over $1 trillion of additional gold demand in a market where the entire annual global gold supply is worth roughly $250 billion. That level of demand would be truly transformative. And here's something most people don't think about. We may already be deep into that process. The central banks don't announce their strategy in advance. They don't hold press conferences saying we are de-dollarizing and buying gold. They just quietly do it, month after month, ton after ton. By the time the mainstream financial world fully understands what has happened, the repositioning will be complete. That is precisely how major financial transitions throughout history have unfolded, not with a bang, but with a long, quiet, relentless shift that only becomes obvious in hindsight. Let me leave you with this thought, because I think it's the most important idea in this entire video. We live in an era defined by the illusion of financial stability. The stock market goes up most years, your bank account has a number in it, your mortgage gets paid, the system hums along, mostly invisibly, and most people never think deeply about the foundations it rests on. But those foundations, the trust in paper currencies, the confidence in central banks, the assumption that global financial infrastructure is permanent and neutral, those foundations are being quietly, deliberately tested right now. The central banks buying gold are not doing it because they expect disaster next month. They're doing it because they are paid to think across decades, not news cycles. And across decades they see a world in transition. A world moving from a unipolar dollar-dominated financial order towards something more contested, more multipolar, and more uncertain. In that world, they want assets that don't depend on anyone's goodwill, assets that can't be frozen, cancelled, or devalued by decree. Gold at $4,700 is the market's way of pricing that transition. It is the most honest signal available to us about where the world's most powerful financial institutions think things are headed. And whatever you believe about the future of the dollar, the fate of the global economy, or the likelihood of a new world financial order, that signal deserves your full attention. The John mindset is all about looking at the world clearly, thinking independently, and making decisions based on reality rather than comfort. And the reality right now is that the financial world is changing in ways that most people are not prepared for. The central banks are preparing. The question is whether you are. If this video gave you something to think about, I want to hear your thoughts in the comments. Do you think we're heading toward a new global financial order? Do you hold gold? Do you think this is all overblown? Let's have that conversation. And if you found value in this breakdown, please share this video, not because it helps the channel, although it does, but because this is the kind of financial literacy that every single person deserves access to. This information isn't secret, it's just underexplained. I'll see you in the next one. Keep thinking, keep questioning. This is the John Mindset.